Hello everyone, welcome to the next section of the Forex Beginners course. And in this section, first of all, we are going to be talking about basic Forex terms. Like I said earlier, in any industry or whatever you are doing, you need to make sure that your foundation and your understanding of the basics is very, very solid. This is going to help you on your journey to whatever you are doing. It is the same in the Forex industries. You need to know the basics and understand the foundation deeply because that is what you are going to be building every other thing on. So let's continue. So the first thing on the basic forex terms is long. When they say long, it means to buy. The second thing is short. So when they say short, it means to sell. So what we are saying here is when you are longing a pair, maybe let's say EUR USD for example, or USD JPY or BTC USD, when you are longing it, it means you are buying that pair. And when you are shorting it, it means you want to sell that pair. And to buttress the point, when you are buying, it means you expect price to go from a lower place to a higher place. And when you are shorting, it means you are expecting price to go from a higher place to a lower place. So the third one is bullish market. What does bullish market mean? It means a market that is going upward. The next one is bearish market. In a bearish market, it is the opposite of bullish market, which means it is a market that is going downward. So note, a currency pair that is bullish means a currency pair that is gaining strength, and a currency pair that is bearish means a currency pair that is weak. Let's take DXY for example. It is the currency index of dollar. So if dollar is bullish, it means dollar is gaining strength. It is very, very strong at that moment. And if the XY is bearish, it means it is weak at that moment. I hope you understand. So in a bullish market, it means a market that is going upward. It means you are going to be buying in the bullish market. I hope you get me, which means to long, as I've explained earlier. And in a bearish market, you are going to short, which means you are going to be selling in a bearish market. So the fifth one is bulls. The bulls are the buyers. They are referred to as the bulls. And the next one is the bears. You should know now. The bears are the sellers. So in a bullish market, it means it is the bulls that are pushing the market. So they are buying the market at that time. So the bears too, when your market is bearish, it means there are every presence of bears, people who are selling the markets at that particular time. The next one, ranging. What does ranging mean? What does a ranging market mean? A market is said to be ranging if it doesn't have a particular specific direction. It is neither moving upward nor downward. This means the market at that particular time is not bullish nor bearish. It means it is not buying and it is not selling. It is just moving sideways. So when this is happening, it means the market is ranging. Trending. A market is said to be trending if it is either moving upward or downward. So this is like the opposite of ranging. If a market is not ranging, then it is trending. So in this trending, that is where we have bullish or bearish. So when the market is moving upward, it is bullish. When it is moving downward, it is bearish. So it means it is trending, either trending upward or trending downward. But when it is not trending neither upward nor downward, then it is ranging. It means it doesn't have a particular direction. It is just moving sideways. Bias. What is bias? This refers to a trader's forecast of where price is likely headed to. When you analyze the market, you are going to have what we call a bias. It means you are going to have a place you predict the market to head towards. It is either you have a bullish bias, which means you expect the market to move upward from a lower place to a higher place, or you have a bearish bias, which means you expect the market to move from a higher place to a lower place. It means you expect the market to sell. So bullish bias means you expect the market to buy. A bearish bias means you expect the market to sell. I hope you are getting it now. Then what is NFP? NFP is an acronym for non-farm payroll. It is a very important news event in the US, which we will explain in details in the consequent chapters. So you are going to understand NFPs later. It is just a news event in the US. So pips. What are pips? A pip is the smallest unit in which a currency pair can change. It is standardized unit and the amount by which a currency pair in foreign exchange markets can change. Currencies are gauged in pips, trade orders are placed in pips, profits are calculated in pips, but can be calculated in percentage too. I'll be explaining that later, how you can calculate in percentage, but mostly your peers they move in pips. So when a pair move, then you can say it's move in pips. It is the smallest unit by which a currency pair can change. So practically everything we do in forex involve pips because when they move, then they move in pips, and that is what we do in forex. We expect price to move. Then it is like the sell of forex. Like I've said earlier, it is one of the most important parts of forex. You are going to be understanding them as we progress. So let's go to pips calculation. How do we calculate pips in forex? We already said that pips is one of the most important things you need to know in forex. So it is only wise for you to know how to calculate pips. Pips is the smallest unit in which a currency pair can change. It is a standardized unit and the amount by which a currency pair in foreign exchange market can change, like I've said earlier. So it is the smallest unit by which a currency pair can change. So let's go into how to calculate pips. For most currency pairs in Forex, we start calculating pips from the fourth decimal place. However, there are a few exceptions like the JPY and gold. Yeah, gold and JPY they are not calculated from the fourth decimal place, but I'm going to be explaining everything in this section for you. So EUR/USD, for example, it is calculated from the fourth decimal place. The pips for EUR/USD is calculated from the fourth decimal place. So you can see after 1, there's a decimal point, then 0.611. You can ignore this 0 because it is called micro pips or pipette. So it is almost insignificant. It's mostly insignificant. We don't consider it. What we consider is the after the 1, the decimal point, then the 4 numbers after the decimal point. Those are what we consider in pips calculation. So from the EUR/USD in the previous slide, 1.0611, take note of it. So you start calculating pips from the fourth decimal digits where there which is 1. If you go back, you can see 1 is the fourth decimal place, 0 is the first, 6 the second, 1 is the third, then the second one is the fourth is in the fourth decimal place. So how do you calculate it? Now, if your USD is set to move a pip, it means it moved by 1 pip. Then we add 1 to the fourth decimal place, which gives us 1.0612. If we go back, you can see it was previously 1.0611. But if it moves by 1 pip, it means we are going to add 1 to the fourth decimal place. Since we said we start pip calculation from the fourth decimal place for most pairs like EUR/USD that I'm making the example now. So if this EUR/USD makes 1 pip movement, then we are going to add 1 to the fourth decimal place, which is 1. Then it becomes 1.0612 after we add the 1 pip move. So how did we arrive at 1.0612? We added 1 to the fourth decimal place number, like I've explained before, and it increased from 1 to 2. So if EUR/USD, which is currently at 1.0611, makes a move of 1 pip, its new value would become 1.0612. I hope you understand this now. So let me re-explain. EUR/USD, the current value is at 1.0611. If it makes a 1 pip movement, then it is going to become 1.0612, which means we added the 1 pip to the fourth decimal place. I hope you are taking notes. Now let's go to another pair. This is GBP USD. So the current value is at 1.2072. Like I've said before, you are going to ignore this little zero at the subscript. Just ignore it. It is called pipette or micro pip, and we don't consider it. We are going to consider the four numbers after the decimal point. So 1.2072, 2 is in the first decimal place, then 0 is in the second decimal place, 7 is the third, and 2 is the fourth decimal number. So 1.2072 is the current price of GBP USD. Now let's get into the calculation. So it is currently at a market price of 1.2072. Now, if GBP USD makes a move of 2 pips from the current value, its new value will become 1.2074. Like we explained earlier in EUR/USD, when it's made a movement of 1 pip, we added the 1 pip to the fourth decimal place. Now in GBP/USD, they are telling us it's made a move of 2 pips. We are going to do the same thing here, but what we change is the number of pip movements. Earlier, it moved just 1 pip, but this GBP/USD, it makes a movement of 2 pips. Now, what we are going to do is add that 2 to the fourth decimal number. Here, the fourth decimal number is 2, like we have explained before. So if we add 2 pip movements to these two fourth decimal place, it becomes 2 plus 2, which is 4. So the new number will become 1.2074, like we explained here. So how did we get this 1.2074? We added 2 to the fourth decimal place number, which is 2, and it's increased from 2 to 4, which makes it 1.2074. I hope you get it now. This is very, very simple if you are following me. Let me re-explain this also. We explained earlier that EUR/USD make a movement of 1 pip, and we added the 1 pip to the fourth decimal place. Now, this is GBP/USD. It makes a movement of 2 pips. Now, we are going to add that 2 pips to the fourth decimal number, which is 2. So 1.2072 become 1.2074 because we added the 2 pip movements to the fourth decimal number, which is 2. I hope you understand it now. Let's take a longer but more appropriate way to calculate peak movements. I've explained the simpler way of calculating it, and I want to believe that you understand that. Now let's go into the longer but a more appropriate way to calculate it. Now we'll take the first example again, EUR/USD, which made a movement of, which is at a current market price of 1.0611. From the example 1, we saw EUR/USD move 1 pip. Therefore, you add 0.001 with your calculator to that original value of 1.0611. Let me recap. I already told you that for most pairs, we calculate them from the fourth decimal number. So if you look at this, if a pair move by 1 pip, then 0.0001. If you look at the 1, it is at the fourth decimal place. It means for every movement of all the currency pairs, then they move by 0.0001. I hope you are getting it. Now, if they tell you that a particular pair make a 1 pip movement, then we are going to add 0.0001 to that particular current market price. So what do we get? 1.0611 is the current market price, like you can see here, 1.0611. Now, if it makes a 1 pip move, then 1.0611 plus 0.0001, because it makes a movement of just 1 pip. So it becomes 1.0612. I hope you understand now. If you don't understand, you can always go back to this video and then watch it again for clarity. So this method seems longer, but actually the real way and the most appropriate way of calculating pips. In the first method, we directly added 1 to the last decimal place number of that value of 1.0611, and we immediately got 1.0612. But in this method, which is the longer but more appropriate way of calculating pips, you can see that as I already said before, you are going to add we are going to start calculating from the fourth decimal place number. So if since EURUSD make a movement of 1 pip, then it means it make a movement of 0.0001. So we are going to add that to the current market price, and it gives us 1.0612. Let me give you another example for clarity. GBP USD again, 1.2072. That is the current market price. Now let's get into it. Let's see the second example above. So it makes a movement of 2 pip from value of 1.2072 to 1.2074. Now, I told you that whenever the currency pair moves by 1 pip, then it moves 0.0001. So since GBP USD moved by 2 pips, then it means that 0.001 in two places. So we are going to multiply 0.0001 by 2. So it will give us 0.0002. So it means when GBP USD made a 2 pip movement, then it moved by 0.0002. And I already explained how we got 0.002. So 0.0001, which is the standard movement, multiplied by the number of times GBP USD moved, which is 2. So we got 0.002. So we then add this 0.002 to the original value of 1.2072. Then we would arrive at 1.2074. I hope you understand it now. Like I've said earlier, if you don't understand it, then you can always go back and rewatch this video for clarity. Let me explain again. GBP USD 1.2072 is the current market price. Then it's made a movement of 2 pips. How do we calculate the 2 pips? 0.0001, which is the standard movement of pips, multiplied by the number of times GBP USD moved, which is 2. Then it gives us 0.002. Then we add that to the original value, then it gives us 1.2074. If we go back to the first example too, 1.0611 is the current market price, and it's made a movement of 1 pip. So we can say 0.0001 times 1, which is also number of times EURUSD move, it will still give us the same 0.0001. Then we add it to the original value, it gives us 1.0612. So that is how to calculate pip movement, and this is the more appropriate way of calculating it. So I don't want this to be longer than it already is. So I'll be going to the next section now, which is the pip calculation for JPYPS and gold. So I'll be doing that in the next section. So thank you.